Chapter 6 discusses the valuation of companies based on their financial statements. Videos for this chapter, as listed here, will be available through links in the text. This video will introduce a set of financial statements for a fictional company named XYZ. This will be used in examples in all but the last section of this chapter. An emphasis in this video is on how the entries of the various statements are interrelated, making it possible to change items in one place and having all the needed related items to be updated accordingly. Let's get started. Assume that the XYZ company's products are a computer peripherals. A few years ago, a new model was introduced and sales jumped, and they've been increasing steadily since then. First is the income statement. Here is the income statement. Note that it's in thousands here, so 75,000 is really 75 million with 6 zeros. And we can go through this quickly. The revenue, 75, they took a major jump in 2013. Into 2014 was jumped. This is the end of 2013 is 75,000. The end of 2014 was 85, so over the year it gained 10 million in this case. And went up a little bit in 2015 and another 5 million in 2016. We had discounts made to customers, which are listed here, returns by customers, both small items but growing. So the net revenue is C4, the revenue minus C5 minus C6, so forth. I recorded them as positives, and so we have to use negative signs in the equations. Next comes the direct cost, labor, materials, direct overhead. The cost of goods sold then is the sum of those three. I use the sum function. And then down here for gross margin, C7, which is the net revenue minus the cost of goods sold. In this case, it's 35,000 or 35 million. We sum up the various categories of SG&A, sales, general, administrative, and they sum to 12,650,000. Subtract out depreciation, get earnings before interest and taxes, take out interest. Note that is just entered directly here. In some cases you probably could compute it, but usually it's entered directly. Same with depreciation here. In other examples in the last chapter we had depreciation tables. In this case I'm just recording the numbers directly to keep it a little bit simpler. Less interest, pre-tax income, subtracting out the interest, C22. And here's the taxes, subtract out the taxes in C24, we get the net income for the XYZ company. The working capital worksheet is shown here. We have 6 categories: accounts receivable, inventory, other current assets, accounts payable, notes and loans payable, and other current liabilities. I recorded the liability accounts as negative numbers. Let's keep it a little bit clearer. And so you get the sum of those, you get your non-cash working capital. Cash is not included in here. In fact, with these changes, it affects the amount of cash, as we saw in the last chapter. So there's the non-cash working capital totals, and we can get the change in cash. Let's assume that the ending cash in 2012 was 17,428, and so the change, the difference between 20 and 17, or 3,512. The difference, a non-cash change in 2014 would be the total 14,226 minus 20,940. So the non-cash went down for 6,714, and the same calculations for these. And that is the working capital spreadsheet. So here's the cash flow statement. We have 3 parts to a cash flow statement: the operations activities, the capital activities, the financial activities. The operation activities are taken from the working capital worksheet and the income statement, as we'll see. We have a beginning balance. This is carried forward from the previous year, 20,013,000 thousand, and so forth. Well, the first year is given, and then we calculate the remaining ones. This 22 is the 20 million plus the 2,250,000, the cash flow, to get this 22, which is just simply copied up here to start this year. The net income comes from up here on the income statement. Depreciation comes from the income statement. And since it's recorded as a positive here, sign doesn't have to be changed. It's right there. And the working capital change from here. We reverse the sign when we record working capital. Additional working capital means less cash, so it's negative, and we get that sum, and do that for all 4 years. Capital activities we enter directly, sum those. We have asset purchases and asset sales. Financial activities, other non-current assets, we have the current assets up here. These are non-current, long-term loans, other long-term liabilities, stock sales, purchases, and dividends, all financial activities which we enter directly. And get a total. The annual cash flow is then as a sum of these three. You see here. And then the ending cash balance is beginning 20,013 minus 2. Would be a plus 2,250. That's a positive number. Would give you 22,263. Here it goes down by 1,914. It goes up again and goes up yet a third time in 2016. And that is our cash flow statement. Next comes the balance sheet, which ties everything together. So we're going to take information from the cash flow statement, working capital, to create the first part of this. Cash comes from the cash flow statement. This is the ending balance, which is recorded down here. E62 is this one, which is E62. Accounts receivable, inventory, and other current assets come from the working capital worksheet. Accounts receivable, inventory, other current assets. For instance, this is in D31, D32, D33. So down here we record that in D31, 32, 33. Sum these up. It's the same for all years. While we're on current, we'll go down to current liabilities. If that was D31, 32, 33, this goes down to 34, 35, 36. From the working capital, that's these three, the next three down. And with that, we can total those, and we have current assets and current liabilities. Now let's look at long-term assets. Equipment, machines, for instance, went from 88 to 98, 10 million. That comes from the cash flow statement. Asset purchases, put out 12 million in cash, and we sold some equipment, received 2 million, so we have a net of 10 million. That's the 10 million that caused this change down here from 88 to 98. And you can see this equation to do that. That's the same for all three. Accumulated depreciation has to be recorded. That comes from here in the cash flow statement or the income statement. 3,000. And so you can see accumulated depreciation went from 5 to 8. We subtract that out. Essentially, you get your book value of machines is equipment and machines minus accumulated depreciation. Other long-term assets went up by 1,000 or 1 million. Long-term assets, here it is, 1 million, and that was brought down. D55. I can find it. Long-term assets. Way up here. Okay. Went up by 1. Subtracted out D55 and so forth. So we get our total of long-term assets. Here's the total of current assets. You sum that together, we get total assets. Now we can do the long-term liabilities. Long-term loans went down by 3 million. That can be shown up here on the long-term loans. 47 down to, say that correctly. Long-term loans went down by 3 million, which is just what we saw here, 88 down to 85, so forth. Other long-term liabilities, here they went down by 2,500,000, which you can see that 70 million to 67.5. So you get total long-term liabilities. Total liabilities are sum of short-term and long-term. And what is left is the owner's equity section down here. The stock stayed constant for 3 years and then changed in the last year. We go to cash flow. Stock sales, there were none in the first 3 years, and we bought back stock. We paid cash out, so our cash balance went down. And so that means this here, let's note that was in F58. So the stock value, we took out the 158, it was a minus above, so you subtract. And we have the stock. Retained earnings is the sum of the previous retained earnings. We'll do this one. D93 is right here. Plus we have to add the net income and the dividends. Net income, way up here, 10,388. And the dividends comes off the cash flow. We paid 5,500. And you put those together. And 122. I think the wrong one. There it is. The 25E59. You get the new retained earnings. So we can add those together. We get 127. That's referred to as net worth, book value, or owner's equity. A variety of 3 different terms we'll see in later ratios we'll look at. So I put all 3 here. The total owner's liabilities, total liabilities and owner's equity, then is the sum of total liabilities plus this one, and that's 307,783. The other sums are the same way. Now assets always have to eat liabilities, so I always put a check on myself. C78 minus C95. Here's C95, here's C78. If you subtract the 2, it should come out to 0. If they're equal, they'll come out to 0, which they do. And just to show you the effect of this, let's go up here and just say our revenue instead of 92,500 was 95 even. That means this is updated. We'll go back 92.5. This is 11,115. Now it's 95. This is 12,290. The 12,290 then is carried down to the net income here, which changes the total cash or working operations activities. But that cash carried down to here, 27,795. Where's the cash flow statement? 27,693. 27,693, which changes total current assets. And then how does it change this? Well, the net income went up, and so the owner's equity, or retained earnings in particular, go up. We'll go back and show you that that used to be 131,938. Go forward, the new cash level, and the net worth goes up to 133, and we end up with the 0 that both statements, assets equal liabilities, and that's what our whole goal is. So we can change anything in there. It's all tied together. Unless you change something with an equation. We can't change current liabilities here because it come from F34. But if we change that up here in F34, That's the number it's put in. It will change everything down below, and you should maintain this zeros everywhere. The last part of this is market capitalization. We have the outstanding shares. We bought back 300,000. Here's the stock price, what the market's willing to pay. Multiply those together to get your market capitalization. And since these values are all in thousands, we scale the market cap. We get down to these four values. Note that this has the zeros on it, and the stock price is per share. So this is not scaled, this is scaled. And that essentially covers the XYZ financial statements.